Okay, well, this will be a busy week in the markets. We're going to get fresh readings on consumer confidence and, of course, the all-important Friday jobs report. And don't forget, 777. That is how much the Dow dropped a year ago from tomorrow. But while others are wary about the future, Jim Paulsen is fully optimistic. He's the chief investment strategist at Wells Capital Management from Minneapolis. And, Jim, good to see you again, as always. And not changing your stance. You're still optimistic about the economy. And I was reading through your latest report. You talk about 6 forces for economic growth. And I want to go through each and every one. Because the first one you talk about is what a lot of people talk about, stimulus. You say that we've seen a big jump in money supply, that the stimulus is working. However, you've got other data saying that since earlier this summer, actually money supply is falling. And there's a lot of talk about what happens when you pull all that money out.
Well, I think, Betty, that one of the things that's important to realize on the stimulus question is that that stuff generally has quite a lag. And I think on average, it's as much as a year. And so I think that a lot of the stimulus we dumped in came after Lehman happened. And it's just now becoming a year where most of that might start to show up on Main Street. It's obviously already kind of gone through Wall Street, but it takes a longer leg to reach Main. It's not just money, and it's not just deficit spending. If you think since Lehman, we also took short rates to zero. We took long rates to record lows. We've steepened the yield curve and kept it there. We've taken oil prices much, much lower and kept them there. So there's a powerful package of stimulus with a lag, I think, is going to start to have more and more positive notice on Main Street.
But, Jim, at the same time, we hear stories about households paring back debt, banks making less credit available. How do those two stories jive?
Well, I think that it's interesting. I believe that many have sort of written off the consumer as they're never going to spend again or they're permanently in a downshifted mode. I think it's far too early to make that assessment. If we're going to assess how the consumer is going to act in the next recovery, let's give a few quarters of positive growth and let's return to job creation before we look at them. There's very good reasons why the consumption is not very strong yet. We're still losing 250,000 jobs a month. We still got falling real incomes. Let's wait. Let's wait for the next 6 months. We get positive growth again. We get some job creation at year end starting. I bet we're going to find out the consumer spendy culture is still there underneath in a little better times.
But the business spending culture, you're saying that the second reason you see a force for economic recovery is a reversal of the corporate purge, meaning that they're going to start rebuilding their inventories, right?
Not just inventories. You've got what happened, Betty, there was, we scared so many people so much about a second coming of the Great Depression. The corporations tried to size themselves to survive that. So they purged payrolls, they purged inventories, they purged cap spending programs to get to levels that they thought they'd have to make it through a depression. Now what we're finding out is not only are we not going to have a depression, but we're going to have positive growth again. So the payroll levels, the inventory levels, the cap spending levels are insufficient for recovery, and they're going to have to reverse some of that.
Okay. The third thing is, guys, the rise in economic confidence. I mean, that's been a bit mixed bag. We've seen mixed data on that. I mean, Jim, how can you be so confident that we are seeing this rise in consumer confidence?
Well, actually, consumer confidence has come up a lot. The problem was it was at such record-setting lows. It fell so much further than ever before. So I think that where we're at, it could come up still a lot more as jobs return and other things come.
We'll be back right after the break. Keep it here. Okay, well, we are back with Jim Paulsen. He's the chief investment strategist at Wells Capital Management. And Jim, we were going through your list, of course, of 6 forces that you see driving economic growth. The fourth one that you have is housing and sales. You're saying it'll add to GDP growth, but a lot of people are saying that had to do with the home buyer's credit, with the cash for clunkers. You're taking that growth and you're taking it away from the future.
Well, I think the thing on housing and autos, Betty, that I'm focused on is not so much the recovery. I think they don't even have to recover to add growth to the economy, because in the last couple of years, housing and autos have been falling so much they've been subtracting about 1% to 1.5% quarterly from real GDP. If they just bottom out, even if they don't recover, they'll be like adding back 1% plus to growth. If they do recover a little bit, that's even adding more. But just the fact that they're not burning a hole in our pocket will feel like a lift to the economy.
Hey, Jim, Adam here. Question for you. You know, Yes, I understand the argument. It's bottoming. It's less worse. But the fact is, depending upon which economist you talk to, there could be 12, 13, 14, 15 months worth of inventory in the housing market. So until that's absorbed, how is that actually a positive?
Well, again, the housing and auto in part is a positive simply because it's a less subtraction. If you've got an economy that's running for 2 years with 1% plus coming off because of contracting housing and autos, if that just stops, it's like a lift to overall growth. It's not canceling out other parts of the economy like it was. So that's one piece of it. But even on your argument, you know, we're noticing new homes housing starts are climbing a little bit here, even in the face of that inventory. And that tells me that inventories are high, but the start rate is so low that even there we could have some recovery just to get back to some reasonable levels.
Okay, and your fifth and sixth, I mean, they're both kind of related. You talk about domestic exports or net exports rising here in the U.S. and also rising mortgage rates and surging energy prices. They've stalled. The net exports, I mean, a lot of people are talking, and the energy prices, saying that, in fact, you know, domestic demand is still very stagnant in some of the big emerging countries like China.
Well, you know, we've been having considerable trade improvement, Betty, for the last 2 years now, and it seems to be continuing. We're now adding about 1% back to real GDP growth rather than subtracting. Just over the weekend, they reported, or late last week, that the volume of global trade went up 3.5% in July, and it also, in the last 3 months now, is up the most since early 2003.
Okay.
So there is definitely a revival of global trade, and the U.S. is seeming to get a piece of that.
All right, Jim, good to see you as always. Thanks so much, Jim Paulsen of Wells Capital Management.